I'm Greg Hunter. Welcome to USAWatchdog.com. We're this regular guest. People, I know when I need to bring somebody back on, as I've said this a million times about some of my regular guests, his name starts popping up. And of course, I'm talking about John Williams, the founder of ShadowStats.com. John Williams, thanks for joining us today on USAWatchdog.com.
Thank you for having me, Greg.
Well, good to be here. Good for you to be here at this time. And we just have a turbulent time. I know you're an economist. You're the founder of ShadowStats.com. You're out with a brand new report, which is a special commentary on the your annual review. And wow, what a review! I just have to tell people on the front side that you're, of all the people that I have on with the newsletters, you have one of the most detailed newsletters, and you are most prolific. You write a lot. And you're certainly not lazy, my friend. And I have some people on with some very, very good newsletters, and yours is one of the best. I get nothing for saying that, folks. I get nothing for saying that. We'll talk more about that at the end of this. But John Williams, I mean, I want to just go with your most recent thing, just out now, and that's the commentary 935. And it's you talked about did the Fed trigger the sell-off? And I think your answer is yes. Let's talk about that. Did the Fed trigger this most recent round of selling?
It looks like it. If you recall the heavy selling, the story was that bond yields were rising. Investors didn't like that. Well, rising bond yields means someone selling bonds. The Fed wasn't actually selling bonds. They just were not rolling over the bonds that they normally would. And they'd increase the amount of bonds that they were not going to roll over at the FOMC meeting in December. There was a big drop of in terms of the Treasury notes and bonds that the Fed was holding in the last week of about $10 billion. That was the biggest weekly decline since August of 2012, right before they introduced QE3, and it's enough to have put some upside pressure on the interest rates on the yields, and that was, I think, probably a proximal trigger. Normally, you don't just crash from an all-time high. Not that it crashed, but you did have some pretty heavy selling. You didn't see much movement in the dollar. You didn't see much movement in gold, and when this market really goes, I think you're going to see the dollar selling off very rapidly, and gold rallying as a flight to safe haven.
But you definitely think that with all the confluences here of things that could have happened, you're saying you could just, the reasonable deduction means that you could only hang it on the Fed and them trying to reduce their balance sheet. That's what you're saying. The Fed caused this latest round of selling. Effectively,
they did in reducing their balance sheet. I'll contend the Fed is in a real awkward position here because the economy's not doing as they're advertising, or at least as you see in the headline data. I think you're going to see a rapid slowdown in the numbers in the next couple of months. And as that happens, you're going to find the markets all of a sudden are shifting back towards, gee, what's the Fed doing here? Maybe they've got to go back to a quantitative easing. And when you see that again, that'll should be a heavy sell signal for the dollar, flight from the dollar. That'll tend to spike oil prices, give us an inflation problem. It'll also tend to spike gold prices. And as the foreign investors flee from the dollar, they're also fleeing from the stock market and the U.S. Bond market. So you'd see stock selling and bond selling, meaning higher yields at the Fed. Fed will come in, they'll start buying up the bonds again. I think that's eventually where we're heading.
One of the people, one of the commenters on my site brought up the fact, he says, QE4, what do you think the tax cuts are? They're talking about $1 trillion deficit. They're talking about all these people, gaining, 3 or 4 million people that have already gotten bonuses, all this money coming back with the repatriation. Are the tax cuts the first foray into quantitative easing, more money printing?
Well, the tax cuts are generally positive. Anytime you cut taxes, that's generally a plus for the economy. The problem is the average guy's still not making ends meet, and anything that increases the disposable income is a plus. This doesn't necessarily go to the guys at the lower end of the income scale at the moment, but generally there should be a little bit of economic pickup here from it. The problem is what happens to the budget deficit. And we just went through a round of government shutdowns or threats of same, and a package that now supposedly lays things out for the next couple of years. But it widens the deficit, and the deficit is beyond control. I mean, we're still looking at when you look at the net present value of our liabilities, we're still looking at $100 trillion that's not funded. You need $100 trillion in hand right now to cover the federal obligations going forward. And we go back to 2011 when when S&P downgraded the U.S. Treasuries. And he was no longer Fed chairman at the time, but Alan Greenspan made a comment to the effect that the U.S. will never default on its debt. Reason for that is that it owes its debt in dollars, and they can print as many dollars as they want. Well, that's true. Although the U.S. could default on its debt with the Congress doing something stupid like saying, "Hey, we're going to default on the debt," when they're having one of their arguments. That's why the dollar or the U.S. Treasuries got downgraded. But the printing of money to meet obligations—that's what happened with the Weimar Republic in Germany. That's what happened in Zimbabwe. This eventually gives you a hyperinflation. And as the markets start to look at this, again, this a budget deficit, ongoing debasement of the dollar, will give you selling pressure in the global currency markets. I'll contend that the administration has an opportunity here to really get things right again. What they need to do is to come up with a credible long-range package for stabilizing the budget deficit. If they have that, they could get fundamental global currency support for the dollar, and with the effect there, I think we're just having a little bit of an earthquake. I'm sorry, I'm sitting out here in California. I'm sorry, I lost my train of
you were talking about the dollar, that they could affect the dollar. They could help the dollar get better by basically cutting stuff. But nobody in Washington wants to cut anything. I mean, they're exploding the budget.
Well, it's not just cutting things; it's a matter of bringing things into long-term balance. It's the long-term insolvency of the U.S. government that the markets don't like. I mean, people run budget deficits, but if you come back and keep things in balance, general balance, you're okay. You can you can have things on a long-term basis stable. Now, right now, I contend the economy is not as strong as as has been advertised. We've seen some boost from the natural disasters, where insurance and savings have funded replacement of automobiles, rebuilding of structures that were damaged. All that's boosted the short-term economy, but the underlying economy is still weak. If the government,
can I just insert here? Are you saying that we're in recession right now? That we are, because it says here in one of your past reports just a week ago, unexpected faltering in U.S. economic activity will not benefit disorderly markets. So you're telling me that this is not over. That looks to me that you're saying that. In another report, you say recession signal intensifies from sinking annual growth in payrolls despite upside benchmarks. And my question to you is: are we in a recession? Do we have a foot? Is the door open for a recession right now?
We have the door open for a recession, but we've never recovered from the last one. If you look at the formal recession, the Great Recession, as some people call it, started the end of 2007. The economy crashed into 2009. Then it started to come back, but it never really recovered its pre-recession high. Now the gross domestic product did, but that's a heavily gimmicked number. It's deflated by too low a rate of inflation. And when you deflate something by too low a rate of inflation, you overstate its inflation-adjusted growth. The difference with the GDP number, the implicit price deflator, is about 2 percentage points. If you adjust for that, what you'll find is that the economy crashed, came back, and then it really didn't come back much. It just been flat. Uh, Informal definitions of the economy. The recession takes you down to a trough. Then the recovery starts once you come off the trough, but you're not in expansion until you recover the pre-recession high. And you look at series such as manufacturing, such as all the housing construction numbers. You look at the stress, employment stress numbers in terms of employment to population. You look at consumer credit outstanding, net of inflation, net of the student loans. These are all areas that have not recovered yet. And until you get above your pre-recession high, you're not seeing expansion. And you have a number of series. You're like, again, look very specifically at manufacturing, which is still a major portion of our economy. It has not recovered. It has not been an expansion for 10 years, 120 months.
So this is, I mean, I'm going to kind of focus into what Donald Trump's trying to do here. He's opened up Anwar, which is a huge thing that with all the nature people just kind of just shrug that off. Because they're drilling on dry land, I much imagine it's a lot faster to get oil out of the ground than going out in the Gulf and building a platform. But he's opened up a lot of the stuff. He's cut all these regulations. He's had this tax cut, which some people say is a form of QE. A lot of companies are bringing this money back to invest in America. I mean, he's in a race against a declining economy, and he's trying to push it back up. He's trying to meet it and push it back up and turn it. Is that right?
That's right.
They know what's going on.
He knows why he got elected. Problem is he's not had a particularly cooperative Congress. And maybe that'll change with the next election.
So he knows the economy is not good. And he's trying to do all the stuff to turn it.
That's the average guy still's not fully enjoying the benefits of all the wonderful headlines we're seeing, and that hasn't changed much. It's the electorate will vote its pocketbook, and come November we have a congressional election. When Trump was elected, and that was a surprise for most political pundits, I contended and thought that you'd see him win because the economy was so bad and the average guy was not making it. That's still the circumstance. When Trump came in, he did not have a Congress that came in with him in as much of an overhaul as he was to the executive branch. Now that opportunity is ahead. If he had a more cooperative Congress, you might see some other things being done here, but they're doing the best they can in the circumstance.
But that is what he's doing. That's
Yes.
why he's doing all the things he's doing. It's all the things. And evidently he must be thinking, well, if we have some inflation and we blow the budget up, I got to get the economy going. Period. The end.
Well, yes. The stimulus will blow up the budget, and all I'm saying is, in terms of having to have a long-term credible package for bringing the budget deficit under control, you need if you have it in place, you can get the support of the global currency markets. And if you have the support of the global currency markets, you can widen the budget short term, do what you need to in terms of infrastructure, funding, or whatever, without really blowing things apart. But you have to have a long-term plan that the markets can buy that says, we're going to be solvent 20 years from now, the United States. You can invest your money with us. We don't have that at the moment. And it's what they just did with this package for the next couple of years. It doesn't improve that circumstance. So yes, you still need stimulus, and if it's not done in a way that's credible, in terms of the dollar remaining stable over time, the markets will hit it hard, and I think that's where the risk is now for the financial markets, is that you'll see a flight from the dollar, and with that, flight from U.S. equities, bonds, and our financial markets will take a pretty severe hit.
You think that a severe hit is coming based on the explosion of the deficit and no plans to reduce it?
Right.
Wow, that's pretty ominous. So the selling is not over in your mind. The selling is not over.
No, it's. I think it was triggered by things other than what I'm talking about now with the dollar. You didn't see much movement in the dollar with us, but that's going to change. And again, as you see the flight from the dollar, you'll have flight from the our markets as well. And that foreign capital is needed to keep propping things up. Who's going to buy the treasury bonds? The Fed. Yeah, that's monetizing the debt. That eventually gives you hyperinflation. Not a happy circumstance.
Yeah, a lot of folks have been, you've been calling for hyperinflation, and that's one of the things. I think it's very hard to predict this because the manipulation is so off the charts. We've never seen this. I mean, who are we kidding? We have never seen the manipulation in the markets like this, the intervention, have we? I mean, we have never seen this before in the history of economics, going back to year zero.
Well, there have been some times in the past,
but not like globally with all the central banks printing money.
Or not globally,
and coordinating together, and they're buying each other's debt, and they're rigging the forex markets illegally, and LIBOR, and it's unbelievable. It's off the charts.
Well, if you go back to we've had the plunge protection team in effect since the crash in 1987. Reagan authorized the setting up the working, I think it's the president's working group on the capital market. And the mission there was basically to keep markets stable, the trading stable. I think it's gone beyond that at times, but they have the authority. The Fed has the authority to go in and, along with the heads of the different markets, to do what's necessary to maintain orderly markets.
Yeah, but I'm saying that what's going on is off the charts, not just the protection. This is fraud, crime, rigging. I mean, they just arrested another 6 people for rigging the gold market. They're rigging the forex market. They're rigging the LIBOR market. They're doing it internationally and globally. I mean, what we have is a scenario that has never been seen before in humankind in the economics realm.
Well,
this up.
Well, you may have. I mean, you've had some unusual times in the past, but nothing on this scale globally. Keep in mind that the banking system effectively collapsed back in 2008. That's the problem. And
I'm glad you brought that up. Hold on just a minute. Hold that thought. I'm glad you brought that up because I talked to you about this in the pre-interview. Somebody sent me this and said, "Hey, Greg, look at this." And this is from the Federal Reserve. This is from Fred. This is a Fed chart. And this is 1975. So we start here in 71 or 72. And this right here, this is today, all the way down here. And boy, see that red line? They're just about touching each other from here all the way over to here. It's the same since like the early 70s to now. And this is the interbank lending. These people don't trust each other, and they don't have any money.
Well, the problem is they never really recovered from the crash. And when I say the crash, I'm talking the threat of the banking system actually failing. The U.S. Treasury, the Federal Reserve, agreed that they could not let the banking system fail back in 2008. So they did everything they had to do to keep it from failing.
I mean, look at this back in 2008, where it just went on a downhill plunge. In a matter of months, it just crashed.
But what they did was they held the system together, but the system's never recovered. It's moribund. You do not have a healthy banking system globally at this point. You still have problems in the United States. They're not lending normally. This is part of what's killing the economy, because what the Fed did. I mean, you hear all the Fed talks and it says, "Oh yeah, we've got a congressional mandate to keep the economy healthy and to keep inflation under control." Their primary function in life is to keep the banking system from failing. It's always been that. They're owned by the banking system. And it's what they did in 2008 was do everything they could. The Federal Reserve bought AIG. That's because AIG was insuring these instruments that were protecting the banks against their bad investments. The federal government stepped in and funded General Motors and Chrysler. But this is, we've never seen anything like that. Whatever had to be done was done to keep the banking system from failing. And the Fed, in order to put the banking system on life support and to provide it with liquidity, entered into quantitative easing. Now, the Fed said, oh, we're doing this, it's going to stimulate the economy. Nonsense. The only thing quantitative easing did was to keep the banks liquid. They're buying up treasuries that the banks had, but very particularly the mortgage-backed securities, which were toxic. Whenever they did this, they'd say this is going to help the economy. Well, that was the bluff and bluster. That was their political cover for quantitative easing. Quantitative easing was never designed to stimulate the economy. Never did stimulate the economy, other than the banking system didn't collapse.
And that's why you're seeing on a long chart this bottom bouncing. I mean, I just heard one of my guests bring up, oh, wow, people keep bringing up, the unemployment rate is 4.1% or 4 point, whatever the fantasy number is. But those aren't your numbers. Your numbers say the unemployment rate is, I don't know, I think your most recent one is 21 and change. If you did it the way it was done in 94 and earlier, is that right?
My estimate is around 22%. The Bureau of Labor.
But how do you come up with that? That's just not yours. That comes up for the way the Bureau of Labor Statistics did it in 94 and earlier, right?
The way they did that, and the key point here is that the people who can't work because they can't find a job, they call them discouraged workers, and they always have. But in 1994 they stopped counting as being discouraged after a year. So he just dropped off the payrolls or off their calculations, and they have a U6 measure that includes the people who've been discouraged here for a year, and people are marginally attached and to the labor force, those who are working part-time because they can't get a full-time job, and you're looking at something that's up in the 8-9% range. That's what they're showing. What I've done is I've re-estimated, had they not changed the system back in 1994 before NAFTA, as NAFTA was becoming active, and I think that's why they made the change, because they knew that NAFTA was going to cost a lot of jobs, which is one reason that you have.
I never knew that. Got it. Okay.
Yeah. President Trump's in because he recognized the problem and at least address those people. But it's not just people who are out actively looking for work or would even like they like work, but they're off the charts at the moment. They're displaced,
and they know, and the real people know this. Despite the lies about it's the best unemployment rate, they're saying real people say what? What are you talking? What? The Main Street says that I don't care how you do the numbers. They're hurting, just like the inflation numbers. They're saying it's like a 1 or 1.5 or 2%, something crazy like that. Your numbers are calculated by the old way the Bureau of Labor Statistics did it. The real inflation number is higher. Is that what we're getting at? The numbers the government are giving are lies, and the Main Street knows it.
The average Main Street has a pretty good sense of what's going on. So yes, Main Street knows it. Always has known it. You can't fool Main Street USA. You can put out propaganda and they'll say, "Whoops, that's wonderful," and maybe some people will buy it. But the average guy knows how he's doing. That's straightforward, simple. Always has been the case.
And that's what Trump is fighting against. Trump is fighting against, and he's got people there that must read your research. I mean, they must get some real numbers from somewhere. They don't. Not everybody swallows them fantasy numbers. You told me that everybody that invests money either uses a service like yours, or uses you, or has in the big banks have their own in-house people calculating the same real numbers, so they know what's really going on. Right?
As far as I know, most people have a pretty good sense of where the
big investors
reality is.
So the big investors don't use the government numbers. Is that right?
I can't say. I'm sure some do. I know some don't.
Yeah, well, okay, all right. And do you think interest rates are going to go higher from here? Do you think the economy is going to fall on its head? Other people are saying, no, this is a 10% correction. Charles Denner says we've just topped out. He kind of agrees with you. We just topped out, and it's going to be lower lows, lower highs, and lower lows. Is that what you think is coming in the market?
Well, in terms of interest rates generally are driven by inflation. You can expect if you have higher inflation, and again they're understating inflation. Normally, interest rates would be above inflation, so that you lend out your money, you get back a little more than what you would have. You cover inflation plus a little bit. Right now, with the Fed's intervention and rates, it has been interest rates have been negative net of inflation. So that's one reason I think the Fed's trying to get rates higher. But the quantitative easing again was aimed at supporting the banks, and the banks have not returned to normal. They're not fully solvent. They're not lending as they used to.
Is the economy in trouble right now, John Williams? Is the economy in your estimation? Are things about to get worse, or are things about to get better?
Well, they're going to get worse. You've had a brief spate of relatively good news here, at least with the headline numbers. And although what's behind them was not good news, that was the terrible hurricanes and wildfires created a lot of damage. The repairs, the replacement of automobiles, things like that, boosted the economy. That's working the way through the system, so that where people have been saying, "Oh, look at this fine growth! Oh, it's just wonderful," it's going to slow down in the next couple of months. You could even have a contraction in first quarter GDP, and that's on a relative basis. It'll be interesting to see how it's handled by the media. They say, "Oh, this is just due to this is post disaster," or they take it as seriously on the downside as as frivolously on the downside as they did on the upside.
But you think things are we're getting ready for a cold bucket of water in the face is what you're saying in terms of the economy.
Yes.
Wow.
That's a fair bet. And again,
and their reaction to the cold water is going to be what?
Well, what I would expect here, despite we have a new Fed chairman in, I wish the gentleman well. It's not going to be an easy time. As the economy slows down, it intensifies the stresses on the banking system. The Fed's function is to keep the banking system solvent. It's never returned to normal. That's what you're seeing in your chart there. Things are not the way they used to be. The system is still not functioning normally. And if the economy gets worse, they're going to be forced to go back into expanded quantitative easing, which keep rates perhaps artificially low. But it's a big negative for the dollar. Again, you get the dollar selling. It can be massive intervention to prop the dollar, but all this becomes system disruptive. You see the big flight from the dollar. You'll see big hits to the stock and bond markets. And the system really needs to stabilize. In fact, as difficult as it may be, it would have maybe been more stabilizing for the system if they'd let the banking system effectively fail, or if they'd reorganized it, as opposed to just bail it out for 10 years and not let the economy grow, because the economy's been suffering from this life support to the banking system.
They should have been they should have taken him into some type of receivership, some type of bankruptcy. You're not the only one who said that. A lot of people have said that. They should have, Bank of America should have been bankrupt. They should have been taken into receivership. A lot of these things should have been reorganized and people taking haircuts. But you can't have rich people taking losses, can you now?
Rich people take losses as well as everyone else.
They would have taken more losses if their banks would have gone under.
If
their bonds would have gone under, they would have taken more losses than the guy on the street.
Eventually, though, the system balances.
Yes, sir. Eventually, the system balances out. John Williams, thanks for joining us today on USAWatchdog.com. Folks, for you and the home gamers out there, just go to the after the interview section on USA Watchdog. You'll find John Williams, shadowstats.com, $175 a year. absolutely unbelievable for the amount of work that comes out, special reports like the one that's out now. $89, I think, for 6 months. But John Williams, shadowstats.com, thank you for joining us today on usawatchdog.com.